key takeaways are that, for me, that the industry needs to do a lot more to make pensions interesting and to encourage people to save. I think it's well known that people, younger people, have lots of different priorities. They want to get on the housing ladder, that comes out from the report very, very strongly, but they don't always have the resources, the financial wherewithal to actually be able to do that. And I think that one of the key messages is that pension saving is important, but it's a long way for people. It's way off into the future, and I think it's really difficult for people to get, younger people to get their heads actually around that. I don't think there's anything I'd particularly disagree with in the report. I think it was a good report and a very insightful report in terms of some of the attitudes and behaviours of younger people. I think that one of the key takeaways for me was that this is a generation that is engaged, it is interested, but I think they have other priorities rather than sort of pensions and saving and longer term savings. So it's not the will's there, but maybe the capability, the financial capability isn't. The industry needs to do a lot more to engage with people how they want to be engaged with, and make pensions interesting for people. Make it, dare I say it, exciting. Pensions are never going to be as exciting as choosing your new smartphone, but actually this is about people's long-term futures. It's important that people save. You work hard all your life. If you want a decent retirement, if you want the longest weekend, the longest holiday, then you need to save. And I think it's incumbent on the industry to engage with people and embrace new technologies to actually drive some of this forward. But it's not just about digital. Digital's really important, it's an essential component. But another thing that came through the report was around the fact that people do value that face-to-face contact. They do value talking to someone, and we shouldn't discount the fact that people want to pick up the phone and speak to people. And I think the report mentions the fact that people wanted longer bank opening hours, for example. So it's about engaging with the customer in the best way for that customer. But financial services industry has got an incredibly bad reputation. We've been through a financial crisis. There are news about rip-off products in the press all the time. That damages trust. It damages confidence. How can we ask people to put money away for 30, 40, maybe even 50 years if they don't trust the institutions, if they don't trust the products that they're actually committing that money to? So for me, it's about trust and confidence. What would I say younger people should do? Be active consumers. Vote with your feet. If you don't like something, make sure you're vocal and make sure you're telling the provider and telling the industry about what you're actually expecting from the products. I do think things are more difficult for younger generations now. There's financial pressure, so there's a whole issue of student debt. It's more difficult to get a mortgage. It's more difficult to get on the housing ladder. I think people are genuinely having families or starting families a bit later. I know that from my own experience, and I think it means that people don't necessarily have the disposable income in their 20s to actually start contributing and thinking about protection products and thinking about long-term savings. So on the pension side, I think it's start saving and start saving early. Even a little bit can go a long way. The earlier you start, even if it's just a tiny bit, the more you're benefiting from investment growth on that pension. And ultimately, it means that you'd have to put less in for the same outcome over the long term. So contribute, and contribute early is my advice.